Every major move in market history had a fingerprint. It appeared before the move. Not during it, not after, before. And the traders who learned to read that fingerprint, who knew what a winner looked like while it was still sitting still, never had to chase another move again. The traders who never learned it spent their entire careers arriving exactly one moment too late. Jesse Livermore did not make his fortune by reacting. He made it by reading. He watched the tape, the record of price and volume in his era, for the behavioral signatures that told him something was being loaded, something was being built, something was about to be released. He called it reading the market. He spent a lifetime refining exactly 7 of those signatures into rules he lived by. These rules are old. They were written in an era before algorithms, before real-time data on every phone, before a single tweet could move a stock 20%. They survived because they are not built on technology. They are built on human behavior. And human behavior in markets has not changed once in 100 years. By the end of this video, you will know all 7. More importantly, you will understand why recognizing these signals before the move, not after, is the single greatest edge available to any trader willing to develop the patience to look for them. Let me describe where most traders are right now. They open the financial news and look for what is already moving. They find a stock that is up 23% on the day and they feel the pull. Maybe there is still movement left. They enter. They experience something uncomfortable. The moment they buy, price begins to stall. It pulls back. It stops them out. Then it climbs again without them. This is not a coincidence, and it is not bad luck. This is the predictable result of entering after the move has already communicated itself to the entire market. By the time a move is visible in the news, readable in the headlines, obvious on the surface of a chart, the traders who built that move are already looking for the exit. And the people buying the headline are the exit. An amateur buys the move after the world can see it. A professional buys the setup before the world knows it exists. The difference between those two sentences is the difference between consistent profit and consistent frustration. It is also the entire point of Livermore's 7 rules. Let me tell you about Cole. Cole had been trading stocks for 18 months when he first encountered this framework. His problem was not that he was careless. He was attentive. He read the news every morning. He followed the sector rotation discussions. He tracked earnings reports. He was one of the most informed traders in his circle. The problem was that all of his information arrived late. The average entry Cole made was 15% into a move that had already begun, which meant his stop loss was positioned 15% away from where the real risk actually started. Over 18 months, Cole had placed 41 trades, and his average trade captured less than half the total move the stock eventually made. His average winner was $620. His average loser was $810. His profit factor, the ratio of total profit to total loss, was 0.76, meaning he was generating 76 cents of profit for every dollar he lost. Cole was not making bad decisions about which stocks to trade. He was making bad decisions about when to enter them. He was always arriving after the fingerprint had already been stamped on the chart and the move had already begun. After 3 months of studying and applying the 7 rules to find pre-move setups, Cole's average entry point moved to within 3% of where the base ended and the move began. His average winner climbed from $620 to $2,140 because he was now capturing the entire move rather than the final fraction of it. His average loser shrank from $810 to $380 because pre-move entries have natural, tight invalidation points that late entries never have. His profit factor climbed from 0.76 to 2.8. One discipline changed. Not the stocks, not the system, not the market. The timing of the entry. Here is the mathematics that makes this permanent rather than theoretical. Say a stock is building a base at $50 per share. A trader who reads the 7 rules enters at $51, $1 above the base high, with a stop at $47, $4 of risk, as the base clearly shows where the idea is wrong. The move eventually runs to $78. That is $27 of profit on $4 of risk. A reward to risk ratio of 6.75 to 1. Now picture the trader who entered after the news story, when price had already climbed to $63. They place their stop at $56, $7 of risk, because the move has already been volatile and their stop needs room. The same move to $78 now gives them $15 of profit on $7 of risk. A reward to risk ratio of 2.14 to 1. Same stock, same final destination. The early reader made 3 times the reward per dollar risked as the news chaser. Not because they were smarter, because they arrived earlier. Entry point is not a detail. It is the foundation every other number in the trade is built on. Now here are the 7 rules. These are not suggestions. They are the fingerprint. The more of them a setup satisfies, the stronger the signal. A setup that satisfies all 7 is the rarest and most powerful trade available to any trader on any chart in any market. Rule 1. The winner leads its sector before the sector leads the market. Livermore always looked for the strongest stock within the first group to show strength. Not the strongest stock in the strongest group, the strongest stock in the group that was beginning to move before anyone was talking about it. The winner does not follow, it leads. Before there is a story about the sector, before there is an analyst note, before there is a news cycle, the future winner is already quietly outperforming its peers. Find the stock that is doing more on up days and holding firmer on down days than everything around it. That stock is whispering something before it starts to shout. An amateur sees a quiet chart and scrolls past it. A professional sees a quiet chart and asks how long it has been building. Rule 2. It has built a base of at least 6 weeks. Price does not launch from chaos. It launches from structure. A base is a period of sideways price movement after a prior advance. A consolidation where early holders take some profit, weak hands are shaken out, and patient buyers begin to accumulate quietly. 6 weeks is the minimum. Some of the greatest moves in market history were preceded by bases that lasted months. The base is not waiting. The base is loading. Rule 3. Volume inside the base is declining. As the base forms, the volume beneath it should shrink progressively. This is one of the most important signals in all of market analysis, and most traders walk past it every day without recognizing what it means. Declining volume inside a base means the sellers are running out. Each week of falling volume inside a flat price range means fewer and fewer sellers are willing to give up their shares at the current price. When the last seller has sold, there is nothing standing between price and the next level. The longer volume declines inside a tight base, the more completely supply has been absorbed. That is the setup. Rule 4. The stock holds its price during market weakness. Here is the test that reveals what is inside a setup. Wait for a day or a week when the broader market is falling. Indices drop. Fear enters the conversation. Most stocks pull back meaningfully with everything else. The future winner barely moves. It refuses to fall with the market because there are buyers willing to hold it at these prices no matter what the rest of the market is doing. This behavior, called relative strength, is one of the clearest signals that informed buyers are protecting a position. Stocks do not hold firm during general market declines by accident. Rule 5. Price tightens to an extreme before the breakout. In the final stage of the base, often in the last 2 to 4 weeks before the move begins, the daily range of price shrinks to its smallest point of the entire pattern. Price barely moves. The candles are tiny. The range between the day's high and low is almost nothing. This is maximum compression. It is the spring at its tightest. It is the deep breath before the first step. Some of the most explosive moves in market history launched from exactly this kind of extreme tightness. The tighter the final coil, the more energy stored inside it. Rule 6. The breakout comes on volume that is at least twice the average. This is the rule that cannot be negotiated. When the winner finally leaves its base, when price closes above the high of the base on a candle that signals commitment, volume must expand explosively. Twice the average is the minimum. 3, 4, or 5 times the average is the signal of a move with real institutional power behind it. Volume on the breakout is the smart money announcing that accumulation is complete and the drive has begun. A breakout on thin volume is a trap. A breakout on exploding volume is an invitation. The difference is visible to anyone looking at the right line of the chart. Rule 7. The first pullback after the breakout is quiet. A genuine winner, after its initial breakout move, will pull back on low volume. Strong hands, the professional buyers who accumulated during the base and drove the breakout, do not panic. They do not sell. Only the weak hands, the traders who bought the breakout move late and are now taking small early profits, exit during the first pullback. Because there are few of them, the pullback is small, contained, and handled on light volume. This orderly first pullback is the market confirming what the base and the breakout already suggested. The sellers are gone, the strong hands are in control, and the move has barely started. Now we need to speak honestly about why these rules are so difficult to act on. Because knowing them and following them are two entirely different disciplines. Your brain is not wired to buy quiet stocks. It is not wired to enter when nothing is happening, when the stock is not in the news, when nobody in your trading circle is talking about it. Your prefrontal cortex, the planning center of your brain, can understand the logic of early entry completely. But your amygdala, the threat and reward detector, runs on a different system entirely. It is watching for social proof. It is waiting for other people to confirm that something is worth buying before it allows you to feel comfortable buying it. This is not a character flaw. Humans evolved as social creatures where following the group was a survival strategy. In markets, it is the exact opposite. The moment a stock becomes visible to the group, the moment it appears in the news, on the trending list, in conversations, the professional buyer is already positioned. The crowd's confirmation is the professional's signal to begin taking profit. The psychological difficulty of buying quiet setups before they become obvious is not an obstacle to this strategy. It is the reason this strategy works. If it felt easy and obvious, everyone would already be doing it, and the edge would no longer exist. An amateur waits until a stock feels safe to buy. A professional knows that the moment a stock feels safe is the moment the risk has already been priced in by everyone who arrived before them. The market does not reward comfort. It rewards the willingness to act on structure before the story arrives. Write these 7 rules down in order. Post them somewhere visible. The next time you are scanning a chart and you feel the pull of a stock that is already running, that is already in the news, already being discussed, already obvious, stop. Ask yourself one question. Does this setup satisfy even 3 of the 7 rules? If it does not, you are looking at the wrong moment in the trade. The move that satisfies all 7 rules is waiting in a different chart, building quietly while the rest of the market is watching something else. Livermore built a $100 million fortune in 1920s dollars, not by being the most active man in the room. He built it by being the most patient. He waited for the market to reveal the fingerprint before he ever committed capital. He described it himself. It was never his thinking that made the big money. It was his sitting. The 7 rules exist to tell you what to sit with, which setups deserve your patience, and which ones to walk away from before the crowd arrives and the opportunity has already passed. The fingerprint was always there. It is on every chart that has ever preceded a major move. It was there before you knew how to read it. The rules have not changed. The market has not changed. The only thing that changes is whether the trader looking at the chart knows what they are looking for. Patience creates preparation. Preparation creates precision. Precision creates the entry that turns an old rule into a new result. If you are going to test any one of these rules this week on a chart you are already watching, type the rule number in the comments. Tell me which one you are starting with. And subscribe now, because the next video shows you exactly how to combine these 7 rules into a complete pre-move scanning checklist. A system you can run in under 20 minutes to find the highest probability setups before the rest of the market sees them. Livermore saw it first because he knew what to look for. Now so do you.